Good morning, Matthew Michael, EMD and Commodities Product Director at Schroders.
Good morning.
So the oil price is on $32. Do you think it's fixed or fragile?
We believe that the strong probability is that the oil price will rise over the next couple of years. Now, that's not the general expectation. What will drive the oil price higher is the fact that many producers find the price today unsustainable for future investment, and unsustainable, at least in the short term, we believe, for many companies. Most of the overproduction has been in America, and it's particularly here in America where we're beginning to see companies feel the pinch. Already we're projecting a decline in overall global oil production for this year, which should balance the market by the second half of the year. Now that means that the price will adjust because we are in an environment where more and more people are using fuel and burning oil and gas, and as a result of that the price should begin to rise.
So how much do you think the price will rise?
Well, based on today's market price, we would need it to go well above $55 a barrel to sustain most production in America. That being said, there are many producers where the price is required to be a lot higher than that. Outside of what we call non-OPEC production, within OPEC itself, again, to maintain fiscal balances, the price needs to be a lot higher than that. So as a result of that, we wouldn't be surprised to see the price above $60 by the end of the next 12 months or so.
Until then, lots of because of the low price, do you see corporation reinvest in commodities?
There's certainly been a lot of people withdrawing money from commodities over the last 4 or 5 years, understandably, as performance hasn't been very strong. That being said, whilst we haven't seen many investors turning to commodities, we feel that there's a lot of capacity for investors to allocate. Now, of course, when you buy commodities, you can buy futures, you can also buy equities, and we think that probably investors will favour both over the next few years. It hasn't started yet, but it probably will start in the next year.
All right, and what do you think about today on Europe when you have a negative rate and people don't save, they just purchase tomorrow? Do you think it's a good idea?
Well, that's the problem, isn't it? If you've got savings and there's no interest to be made in banks, people will be looking for alternative investment ideas. And actually today we're in a unique scenario, one that we haven't seen for many years. You've seen emerging markets crash.
Yeah.
Government bond yields in emerging markets now are high single digit. In Brazil, they're 16.5%. The oil price is 70% cheaper than it was years back. Gold market, of course, is very interesting. Very cheap relative to the peak that we saw in 2011. And they're all under-owned. Investors don't have any, if much, exposure at all. So there's a wonderful combination of value and also a timing opportunity potentially. So for investors, for savers, clearly you're going to be looking for places to make returns, and maybe these are the areas you want to be looking at.
So just looking for the next opportunity. Thank you very much, Michael.
Thank you.